I became such an advocate for the companies I invest in that for me, the notion of having a creator be that person, that investor, is such a smart choice, right?
And so if they help a business grow, it's only natural they capture some of that output as well, right?
So what is smart business model, I think?
Welcome to the Ready, Set, Click podcast, where we talk digital marketing strategies. Grab a coffee or something a little stronger and settle in for this episode.
So welcome back, Vivian, to an episode of Ready, Set, Click. I am filling in for Paul Kahn today, so thank you.
Irreplaceable Paul Kahn.
Irreplaceable Paul Kahn, of course. But yeah, so today I have one of my favorite topics of the moment to discuss. So I'm really, really happy you're here, and you're the perfect person to talk to.
Am I now?
We are going to talk about creator equity deals. Okay, rings a bell?
Yeah, it does.
Otherwise, it's going to be a short podcast.
Or a painful podcast.
A paid podcast, yeah. Can you, when I say that, what do you think about?
So I love it. What is it to begin with? What's equity? It's being an owner in a business, right? So basically it's a company of some sort and a creator working together. So the creator gets equity, gets ownership of a company, right? Essentially, that's what it is. It can take many forms. It can be given, can be bought. We can discuss the details, I'm sure we will. But I think it's really exciting because it's really the continuity of what we've seen in the industry, which is creators taking more ownership in every possible meaning of a word, right? Taking more ownership of their audience. We've seen lots of companies like Patreon you might be familiar with. It's a way for creators to monetize their own creators by creating subgroup, giving value to their creators. Fantastic way. We've seen a lot of affiliate deals, and we certainly have seen a lot of this at Upfluence, where creators get actually commission on all the sales they bring, so they don't just take maybe a partnership deal upfront money, they actually have the upside as well. And I think the ultimate upside is to capture the enterprise value they help create, right? And so if they help a business grow, it's only natural they capture some of that output as well, right? And so very passionate about the topic.
Yeah, and I mean, like, not to disclose everything, but we both are angel investors on the side. So we invest in like companies we really like. And one thing that for me changes the minute you invest in a company is that you feel a lot more involved, right? And you follow the progress of the company over years and years and years. And I became such an advocate for the companies I invest in that for me, the notion of having a creator be that person, that investor, is such a smart choice, right? Because they have me, I talk to people here and there. Yeah. They talk to people, millions of people every week, right? So what a smart business model, I think.
You're right. And not just the reach they bring to the table. A lot of this time, these guys have vertical expertise, right? If you're a consumer tech creator, you know this shit inside and out.
Yeah, that's true.
You know, so I think they bring a lot of credibility, not just viewers.
Yeah, and I mean, like the deals are more common, but they're still reserved to kind of an elite creator. Kind of, I feel like it's not accessible to anybody, right? When do you have a deal like like something that you immediately think about when you think equity deal with creators? Is there something like for you that like, yeah, for me the best deal is this one?
I don't know if it's the best, but a really cool one is Alex Earl and Poppi, right? Poppi being this great brand of, flavored water, soda, like there's hundreds of in the US, right? So the product in itself, cool packaging, cool marketing, 100% hats off to them, but the product itself is not that differentiated from the rest of what you see in the market, right?
So boilerplate, right?
So boilerplate.
Yeah.
But what they did, I think, really smartly is early on they brought these influencers who actually bought equity, who actually got skin in the game. And fast forward a few years, Poppi has sold to PepsiCo for nearly $2 billion.
Yeah, and that's crazy because I am ready to gamble that they could play that scenario a million times. And if they didn't have the right creators on board, it would never work.
Yeah, I would agree.
It's like even celebrities, I don't think would be a good enough match for the brand because the level of involvement would be much lesser. It would be more like mercenary driven, except if they have equity that they purchased, but it would be a much more complex deal. And what do you think, how much do they own of the business?
So I think that mostly depends on how large the business is and what kind of role they have in the business, right? I think just on an advisory kind of role, it's probably sub 1%. And for
So
reference,
what would be advisory in that case?
so
Because you're not going to ask for advice, right? You're going to ask for something, I guess. Maybe you need some advice too. It's like,
companies have advisory boards for where to take their product next, how to drive the roadmap or whatever it is, right? So because some of these creators are very vertical expert, in some technical subject, they can bring this to the table. But in that case, I think what has more value, and that's the second type, is really the communication piece. So they become spokespeople for your company. In that case, we can go single digit, anywhere 1 to 10, I would say would be
so
fair.
that's for a company starting out.
Yeah.
So like I have zero revenue, I have this great idea, I come to you with a PowerPoint and we're like, let's do this together. And in exchange, you'll get 1%.
You're right. And I think there's the extension of that, which is in which the creator is really a co-creator, is almost a co-founder of the company. And I don't know if timeline-wise it's exactly the case, the Marcus Brownlee with Ridge, right? So Ridge, the wallet company and keyring and everything. Great product, fantastically
I
made.
think it was Kickstarted, was it not? I'm not
It
sure.
might have been.
Yeah,
might
I'm
have
not
been.
sure. Yeah.
But I know Marcus joined very early on, and actually he didn't just join on the cap table. He actually joined operationally as well, right? He's a creative partner, executive creative partner, or something like
I
that.
always wondered what that meant. As somebody that works in the corporate world a little bit,
It's like
think you're
C-level, but not quite.
yeah, it's like I'm creative partner at the same. Like, what does that mean?
Still, I think it's an insanely good deal for Ridge, right? Because
I mean,
the
what
value. Yeah.
what a value, man.
Yeah, he's been on board for years now. He's talked about it constantly, but always very genuine, or never pushy, disingenuous, I would say.
And he always discloses that he is an investor, that he has a stake in the success of the business. So I think that makes sense. I agree that I think that's probably my favorite like equity deal with the creator. I think Marcus Brownlee is like, what I like about it wasn't core business for him. So he decided to pick something that he doesn't organically cover. And I think that removes the temptation or the thought about like, oh, I'm gonna feel biased if I ever talk about that brand, right? And I think that was a very smart choice. And I think for every brand that is thinking about who is my ideal partner, the logical thought you're gonna have is like, oh, well, I'm in finance, so I'm gonna wanna have a finance creator, right? But actually it might not be the case. You might wanna go for somebody who can use the reputation, talks to the general public you're targeting, but doesn't cover your area of expertise, so you can remain like non-biased, right?
I think you're exactly right. And to your second point, still about Marcus, true, Ridge is not exactly his focus point, but the audience ate that up.
100%. It's so spot on.
Yeah, because they're exactly in the gadget, gizmo, tech kind of vibe, and this is the perfect.
They love the new stuff that's flashy, right? They love smart things. They don't want a big, bulky stuff. And I think he could have gone any other way, and he didn't. And I think there is another example with even like SaaS companies. Like we talked a little bit before the episode about I think it was Charlie D'Amelio, and you told me she had a stake in a teenage bank, right?
Yeah, that's right. I forgot the name. I can't think of it right now. But not only that, she also has a stake in Lightrix. So the company that does all the creative tools for creators, and that's hundreds of millions of ARR, like super successful. And she has a meaningful stake, her and her family, right? So what an example of putting your money where your mouth is, right?
Yeah, and also like, I mean, if you've ever seen Charlie D'Amelio's content, it doesn't scream she's a SaaS mogul, it's like a software, as a service, kind of subscription-based model, like mogul. Like it's really smart, but I think these brands get it right. And I think creators tend to do these kind of deals kind of like asynchronously, or like not asynchronously, but asymmetrically, right? In a way that it is not exactly what they talk about, because they can keep their independence fundamentally.
You're right. But that makes them tiny VCs, right? Tiny venture capitalists in a way.
Well, and that's a really good point. So one thing we didn't talk about is that right now we're talking about gifting like shares, right? 1%, 10%, which by the way might seem very small, right? But it's actually a huge amount of money. 1% of a decently sized business, and if you're big enough as a creator and the product is good enough, there is no reason why you wouldn't pick. even 1% of a decently sized business that's growing could be worth millions, and easily millions, right? I mean, I know of examples recently, like I'm sure like Lightrix is probably worth multiple billions.
Most likely, yeah.
Yeah. So as an example, if her family and Charlie D'Amelio's have even like a fraction of a person, it's worth real money. But aside from this, I think that one interesting type of things is like when creators become investors, where you don't give them shares, you make them buy the shares, right?
Yeah, you're right. So at the end of it, it's an arbitrage that they have to make, right? Because creators are a business. They need money to produce great content, to invest, and to hire people and manage everything. But if they can sort of forego that money and invest into a company instead, yes, they might walk away from, and I'm going to use a random number, a $20,000 brand deal, but instead they might get a multi-million equity ownership of a company, right? So it's delayed gratification. It's the ultimate marshmallow test. Sorry, I love it. And yeah, if they can afford it, I think that's a very smart move to have a stake in a few companies. You can diversify your risk. You can really have a portfolio management approach to this.
Yeah, and a couple of things I think really make sense here, right? The first one is every company needs money. Any company that needs to grow needs money, basically. And we always go to like VCs, which are like institutional investors. And that's helpful, but VCs always tell you like, oh, I'm gonna bring you money, but I'm also gonna bring you like talent, teach you processes, like bring you customers. And you do the deal with the VCs and the only thing they bring is basically, money and sometimes headaches, right? No disrespect for our VC friends, you are very essential to the ecosystem, but fundamentally, it's true. You don't really help the business, right? It's like that's a fact, right? And I think when you work with the creator, if your business angels, if your VCs are creators, it's such a phenomenal like competitive advantage, right?
Absolutely.
These guys, like, imagine like the power of a Marcus Brownlee for Ridge. Yeah. Like, they don't even need a marketing department, man. And if they need to get introduced to super big tech, other YouTubers or people on wherever else, guess what? He picks up his phone and he calls whoever you want.
No, you're right. I think if I were CEO of Ridge, right, obviously you need some money to scale production, for R&D, to design the product, and that, regardless of who's backing you as a VC or an angel, you're going to need that money, right? But the upside you can get by having creators on your cap table is virtually uncapped, because that money that you would have spent on AdWords, which would have been, a one-off thing,
spots or whatever.
Yeah. You're absolutely right. And any sort of paid marketing, that would have been a one-off thing, right? And you would have had to raise your next round and your following round and your following round, which every time comes with dilution, so you have less control of your own business and everything. So it comes at a cost, right? But if you have creators, they will push organically your content forever and ever and ever, because they have skin in the game, right? They believed in the product enough to put their own money on the table. They are going to bring you further. And two solutions: either you never need to raise money ever again, congratulations, you're a profitable business, you can exit, in great conditions. Or if you do, you're going to save a lot of time, you're going to have much better metrics, higher revenue, and if you raise on a revenue multiple, in that case, it's a much, much better deal for you.
And what I find smart about all of this is how it's not obvious to me, like, right, to make them purchase the shares, but I think you have multiple things that align here. The first one is when you launch a brand, if you pick people to give equity to, you want them to be pretty big. Usually in the world we live in today, these guys tend to be wealthy. The people in the multi-million, subscribers, followers, however you want to name it, depending on the platform, tend to be multi-millionaires. Yeah. And I think a lot of them are looking to also invest that money wisely for the future. And that brings to the second thing, which nobody wants to talk about because it's not very interesting, but it's taxes. While they would get taxed heavily on a multi-million-dollar deal in cash, in equity, the tax is zero, and when they finally exit and sell their shares for much more than that one-time deal, that's taxed on capital gain, which is a very smart thing to do, because it's basically half or a quarter, sometimes even, of what your actual tax rate would be. So I think that's a really, really interesting take, and I think for the it's not like on the the Maslow pyramid, like of your actual needs. It's not like base needs, right? Like water, shelter, or whatever. It's more like, hey, I have done all these things. I've made all the money. I have the audience. I'm assailed by brands that want to work with me, right? I'm receiving hundreds of messages from brands every week that want to work with me, right? Yeah. So now what I want to do is I want to take part in something bigger. I think it's so organic. It's so smart.
I think you're absolutely right. And I think as a creators, your creator business is a great lifestyle business. But if you want to build, wealth and generational wealth in some cases, this is the way to go, right?
Yeah. And also, once again, time horizon totally different. So we're talking about all the great stuff doing equity deals, but I wouldn't be honest if I said that wasn't a downside, right? Sure. Do you have an example in mind of something that went like a little eerie or wrong?
Well,
or at least what could go wrong.
Yeah, what could go wrong. I think if you work with a small number of creator investors, or if you have a small number of large creators on a cap table, you have a higher reputational risk, right? A risk that a creator says something out of whack, and basically by association, you're guilty by association, and that hurts your business in return. The most probably well-known celebrity example is Kanye with Adidas and all his brand deals.
It wasn't great. Even though it's probably not an equity deal, or at least not just an equity deal, but definitely what a catastrophe. Right?
Yeah, for sure. I don't know how many billions of market cap were wiped off that day. So even if it didn't have an equity ownership, at the end it impacted the equity of everybody else, right? So that's an obvious one. But there are many such cases. Even Logan Paul, who's involved in many businesses, had some, not necessarily good positions on the suicide forest and all
I
that
don't know
stuff,
how
right?
these guys always make it out, right? Because I don't know. Anyways, it's not really the thing we want to discuss today. But.
No, but I think where it becomes interesting on the entrepreneurial side of things is you can choose to either work with one or a handful of very large creators. In that case, your risk is kind of concentrated. Or maybe you want to work with a larger number of smaller creators, maybe 500K followers or something like this. Very high expertise, niche, exactly on what you want. And in that case, that risk is sort of, broken down on a larger number.
It's funny you say this, because my take on equity, period, for most people, and I'm talking 99.99% of people, it's a very intangible thing. It's something they don't really get or value. Right. So I know in our business, we give shares and equity to every employee after a year. And yet I can guarantee if I ask anybody what their shares are worth, nobody knows. Yeah. And I think they would never take that into account as part of the salary they get or part of the wealth they're creating. Right. They just see it as something that is given to them every year. And I wonder if by working with so many smaller creators, what you end up doing is diluting a little bit that effect, because the amounts are small. Even if it's $20,000, which for a small creator is huge, right? It will just not look like this. And if they want money out of it, it won't be liquid, right? So it's. I've always wondered about that paradigm, or that paradox. Sorry, I've always wondered about that paradox of if you dilute it too much, it feels insignificant because it's 0.011% of it.
I think you're right. So, a couple of thoughts. There's the employee side of equity, there's the investor side of equity. Sometimes an equity deal is what we call a club deal, where there's 10, 20, 30 investors that get, collectively 5% of the business, but individually they own point something, right? And I think that falls more into sort of that category. That being said, I think the bigger piece is education, right? Because it's true that if you come to a creator saying, hey, let's work together, I'll give you 0.5% of my company. So no, I'm going to give you 100% of my followers. Why would I get 0.5% of your company? This is stupid. Yeah. But in essence, you said our employees don't necessarily know the value of the stocks. I think you're right. But if you go in the Silicon Valley, most of early engineers job offers, it's 150K and 0.25% or something like that. Yeah. And that guy, to earn this stock, is gonna work 4 or 5 years full time, 100-hour weeks, and give his all to actually grow something meaningful. So, it looks small, and in absolute terms it is, but
The value.
the
is
value
high.
is great.
Yeah.
And if we talk about startups and fast-growing companies that may exit at billion-dollar valuations, the valuation can go up really quickly, right? Let's say it's the first time the company is taking in investors. They, add a creator for 0.5% of equity. Let's say the valuation at this very point of time is 10 million. It's not unheard of that 18 months later they raised a new round, and that round is at 5x, 10x, 20x the valuation.
$200 million, right?
Yeah. Exactly, absolutely. So then that 0.5%, even though he has taken maybe 20% dilution, something like this, the net value is incomparably higher.
Yeah, and my take, totally personal, is that if I launched a company tomorrow and I wanted to do creator equity, I would work very, very hard